real reason we went to 90% was because we heard chatter that the SEC had reached out to these issuers to talk about their prospectuses, to give comments back on these S1 documents. We haven't seen that yet for the Ethereum. The Ethereum ETFs, there have been some S1As, but they haven't been drastic changes or unique changes. For the most part, the ones we've seen are more bringing these Ethereum ETF applications in line with the things they learned going through the Bitcoin ETF. So they're changing things like the cash versus in-kind that we talked about. So that was obviously the SEC did not want in-kind creation, not anything specifically important to Ethereum itself. So if we start seeing a whole bunch of updates from all these issuers that are unique to Ethereum, that means the SEC is talking, and then my odds would go up. If we don't see that in the next month or so, we might have to decrease our odds.
Hey everyone, thank you very much for joining us for another episode of CFB Talks Digital Assets. We are the home of informed conversation about crypto for institutions building the future of finance. I'm Ken O'Deleger, Head of Content, and I'm joined as usual by my colleague, Gabe Selby, who's Head of Research. And today we are absolutely stoked because we are also joined by Mr. James Seyffart, who is a Bloomberg Intelligence ETF analyst. Welcome aboard, James. Thanks for joining us.
Thanks for having me. I'm happy to be here. Happy to get into it.
Brilliant. So I think a good way to start off with this is it is James Seyffart CFA, and also you've got a KIA sort of accreditation as well. And you basically all of your working life you've worked covering asset management, and I'd say TradFi, markets in general. So the question that arises is, what piqued your interest about crypto, and also when?
When? So, I mean, technically speaking, I actually, my laptop, I had a laptop in college where my suite mate downloaded Bitcoin mining software in the spring of 2011. So I was mining Bitcoin in the spring of 2011. So it goes way back. That said, my laptop crashed and I hated Bitcoin for a very long time after that. I didn't really take it seriously. I had a buddy who just he talked about magic internet money, whatever. So that was my first interest to it, which was not good. Like many people, I heard about it, I looked at it, and I thought it was stupid and wasn't really interested. The second time I came back to it in the fall of 2016, Kathy Wood of ARK Investment wrote a white paper on like why she was a believer in Bitcoin and what it could do as a monetary network. And that's when I really started getting into it. And I got interested personally at first while I was still in Bloomberg Data at the time. So I made my first investments into Bitcoin in early 2017. Not much, just downloaded a Coinbase account, normal stuff. And then I moved over to Bloomberg Intelligence, Bloomberg's research arm, in the fall of 2017. And when I joined, I worked with, as you mentioned, I was on the funds data side, so just covering asset management in general, primarily ETFs. But when I went to the research side, I reported to two people, Eric Bartunis, my colleague and current boss right now, and Mike McGlone, who was our commodity strategist. And he basically asked me and another colleague who has since left to start another crypto firm a few years after this, but this is 2017. And he was like, what do you guys know a little bit about crypto. I need to start covering Bitcoin from a commodities perspective. So I spent a year and change covering both ETFs in general and Bitcoin as a commodity asset from a commodity strategy point of view. And so that like expertise and both my personal interest gave me a lot of like confidence to cover what was going on with these Grayscale trust products, namely Grayscale's Bitcoin Trust, GBTC, the Ethereum Trust, and all these other things. So there was this good overlap between those two things. Like if you look at it as a Venn diagram, and I was like, my expertise sits squarely in the middle here. And there was just a lot of people in TradFi at the time that really didn't understand these digital assets. So obviously that also gave me some expertise to cover the Bitcoin ETF application. So I've been covering them since 2017, really, from a professional point of view. And Eric was talking about and covering the Winklevoss twins application back in 2013 all the way through to when we finally got them. So we've been on this for a very long time, covering this space, and it's been a lot of fun. But yeah, that's where my interest personally started. But it's been a nice, kind of one of those things where like a huge chunk of the world became interested in this one niche thing that I had some minor expertise in. There's other people that could do it, but the people that were really able to do it were working at the funds trying to get these things launched and couldn't really talk about it publicly. So I just kind of got lucky, I guess, in a way. right place, right time.
No, it's important because as you suggest, a lot of people were just parachuted into the scene, mentally in terms of their awareness. Just, oh, these guys are talking about crypto. They're probably a little bit more expert than me, but it's great for you to contextualize your background pretty much from the beginning when it became a proper market asset. So, Gabe, I think you've got some questions as well.
Yeah, James, welcome to the show. Really excited to have you on. As a fellow terminal subscriber, I'm a big fan of Bloomberg Intelligence. I like following all the analysts. I cover all the asset classes. It's kind of like my checks and balances. As someone who mostly focuses on crypto, I still have to kind of stay abreast of other asset classes and the macro picture. And the Bloomberg Intelligence team, if you haven't ever checked them out, I would just give a shout out to them. You got Gina Martin Adams on the equity side, Audrey Child-Freeman on FX, Ira Jersey covering fixed income, Mike McGlone on commodities, and the macro side has been covered really well too. So big shout out to them. But James, I want to ask you, what's been the biggest surprise so far with this whole ETF saga? I think there's been a few folks that have tried to, downplay maybe like a sell the news type event.
Still waiting.
This week's been a pretty interesting week, but I won't go into too many details, but I just want to get your take on that.
I mean, first, before I even answer that question, I'm impressed you knew all those names. That shows you're actually listening. So Ira sits
really
right
does.
next to me in our offices in Princeton, and Gina is my boss, Eric's boss. So my boss's boss, and so I talk with Gina on a regular basis as well. So yeah, they are part of the benefit of being in Bloomberg Intelligence, not to like toot our own horn, is that like I have a lot of people I can lean on for like, oh, we're covering this and I need to ask their view. And they're like, we have specialists and everything. So we have a litigation analyst who's covering the Grayscale case. We have a guy down in DC who covers like regulatory agencies and laws and bills and things like this. So I can talk about what's going on in Congress. And we have people that cover like MicroStrategy and Marathon and Riot and Coinbase. So I know like kind of how things are going on the equity side. So like a lot of my decisions and like informed guesses and estimations of those probabilities that you talked about, Ken, come from not just Eric and I deciding this. That's like not the vast majority of it, but we have a lot of other people we can lean on to get input and like debate with and figure things out. So it's been it's a huge benefit we have that I think a lot of people online don't realize that it's not just us. There's a lot of people helping us out. And what's been the biggest surprise for me? The flows. I mean, I thought there was going to be immense demand, but I thought it would take time. Like if you look back at some of my tweets in early January and like in the first few days, I kept telling you, just relax. It'll come. It takes times for these wirehouses, these brokerages, these advisor platforms to basically onboard these ETFs for available to be invested by these advisors and brokers. So I thought we'd see 10 to 15 billion in assets in the first year. That was like my rough estimate. We're at 7.5 and we're exactly 7 weeks from launch. That is, I don't know how else to say it. I mean, we have IBIT that hit 10 billion in 7 weeks. Nothing else has even come close to that. Yeah. I was looking actually this morning to try to find the second fastest besides iShares is IBIT, and the second fastest I could find is Q at like a couple hundred days. So we did this in 7 weeks.
That's unbelievable. Wow.
Yeah.
And if you were to take out the, some of that noise that you get from the GPT sales, which we can attribute to maybe several factors, but it's really hard to pinpoint and quantify. But you've probably got some that arbitrage, hedge fund unwinding. You probably have some people swapping out or substituting maybe to a cheaper fund, and then you also have these litigation cases. So if you were to take that out, I looked at the numbers here. We're at close to 16 billion on these new funds if you were to take out the negative nets from GBTC. But one thing I wanted to jump back on, which is something you kind of hinted at, is discussing that internal dialogue. How does the Bloomberg Intelligence team maybe share a little bit more details of how you guys derive these Bitcoin ETF approval probabilities? I mean, you guys have folks on the ground in DC, like you're saying. Certainly the judicial outcomes with GBTC and the SEC played a big part in eventually getting us a spot ETF, right?
Yeah. So the odds. So people are like, there's no quantitative analysis in these odds that we were giving them out, right? Really what it comes down to is Eric and I talking to all those people that you just mentioned. I mean, we do this, a bunch of us across the department do the same thing. So Elliot Stein is that litigation analyst I was talking about. before the oral arguments in the Grayscale case, he said that he thought there was a 40% chance of victory for Grayscale. He thought it wasn't that crazy. And I can't tell you how many people were telling me that the Grayscale lawsuit was a frivolous lawsuit and they were just going to get thrown out and all these things. And meanwhile, I'm like, this is far from frivolous. They actually have a shot at winning. And I got eviscerated by a bunch of people on Twitter, specifically the TradFi guys. After the oral arguments, me and Elliot went to 70% chance of victory for a Grayscale. And again, eviscerated. But what we're really doing there is one, like, obviously trying to think like how probable do we think these odds are? We kind of think of, those ESPN, like when you're looking at a sports game and like the score is going up in one direction, it's like probability of victory, but like you could still drop all the way down. Just like in the Patriots Super Bowl against the Falcons, like it was like near 100% chance of probability, and then it wasn't. But we try to think about it like this, right? So at what point would you like buy the probability that it's going to be approved? So if you think about these betting markets, like if it's an 80% probability of Bitcoin ETF get approved, would you buy the yes approval or would you buy the no? So we try to find that mark where we're actually debating around it, and then that's what we go with. And sometimes we don't fully agree on them. When we initially went to 90% in early October of 2023 for the Bitcoin ETF approval, Eric was actually higher than I was. So I was more in the 80s at that point because I wanted to leave room to increase the odds. But Eric was like, "No, we're going 90." So we went 90 essentially. He overruled my view, and we kind of agreed to it. But part of the problem was we also couldn't raise it when some other things happened. We heard some more news so we went to 95 in early January after we heard more and more stuff. But for the most part, that's how we're backing into these things.
I'm certainly glad that we didn't have I'm not sure what year that Super Bowl was, but it was like the biggest comeback in history. Those New England Patriots upsetting, what were the halftime winners, the Atlanta Falcons. Certainly, I left. I was at a bar watching that game, and I left early, and I was in the Uber home refreshing it, and just saw that score getting closer and closer. And sure enough, Tom Brady, pulls us off. But glad that we got the spot ETFs across the finish line, and the 80% buy certainly seemed reasonable, especially as you kind of got more into the revisions or the comments from the SEC. But Ken, what were you thinking about the overall market and how Bitcoin's going to react?
Yeah, I mean, before we do that, actually, I wanted to move back to something that you alluded to earlier, James. We are about, I think we're about 7 weeks or something like that since that launch back there on the 11th of January. As you've so eloquently described, we are regularly still seeing 7 weeks later records being broken across the board on all sorts of metrics, volume, liquidity, inflows, outflows, BTC. And as you again indicated, we're really at just the beginning of the beginning. In terms of onboarding, we haven't really seen that happen yet. I mean, there are certain counterparties, there are certain players, major asset owners. You think about pension funds and others who basically are just still doing their due diligence, and they've got liquidity sort of like and eligibility requirements that are still maybe waiting to be fulfilled, or if they're happy fulfilled, there still needs to be some sort of waiting period. The idea is that basically once they do come on board, will these figures that we're seeing, will this palpable demand that we're seeing, prove to be the peak or some sort of peak, or could it actually exponentially, increase? That's the main question. There's a lot of people's minds who are watching closely.
Yeah, I mean, the question is right now, there's no way to know exactly who's doing all of this buying. So we'll have a better idea sometime in mid-May because we'll have the Q1 13F reports, which kind of tell you who owns different equities, and ETFs are required to be reported there. So we'll know if any institutions or some of those players you were talking about have been big buyers of these ETFs once those 13F reports come out. So I'm looking forward to that. That's the first thing I would say. The second part is, I don't know how much of this is front running those big players that we're talking about. And maybe like it's going to take more time for those big players to come in. Maybe some of them are in. I know for a fact, some of these big platforms have already approved 3-4 of these ETFs to be bought by advisors. I've heard anecdotes from different people who were actually taking people are gonna be so upset by this if you're a true Bitcoin maxi. But I've talked to multiple people who are taking Bitcoin out of cold storage and putting it into these ETFs just for like family
Wow.
planning and
Wow.
will type stuff. It's just way easier to be in a brokerage account for them in their point of view. Also, some people have advisors, and the way that a lot of people are looking at this, they're not putting 100% of their net worth in this. I know there are some people out there that are doing this. For the most part, people are looking at 2, 5, 10. I've talked to some people that are at 20% of their net worth in something like Bitcoin and ETH. But for the most part, advisors are going to target a set allocation, right? So as the price runs up, there'll be sellers, and as the price collapses, there'll be buyers if they have a set allocation goal, whether if it's 5% of a portfolio. So one, I do think that will dampen volatility a bit, which could be interesting coming down the pike. But as you mentioned, the way that these platforms often work is people think like, oh, once they're approved by the SEC, everyone can buy them. Like all professionals can just put these in their client accounts. And that's not how this works. It usually starts with no one can touch these things until a team does some sort of due diligence or some sort of research process before they allow people to buy them. And there's usually like tiers. So these things came out, a lot of these platforms, anything that comes out in the first month, 2, 3 months, no one can buy it. We're going to do due diligence. We're going to look at the managers of these funds. We're going to look at the processes that they're using. And then we'll say, okay, you can do this. And usually there's tiers in the middle there where it's like, okay, you can only do this if the client comes to you and asks for it. You can't recommend it. That's the difference between solicited and unsolicited. Or like maybe it's like, okay, you can buy this for a client, but you need to jump through all these hoops, fill out this paperwork explaining why you're buying it for them, why they have the risk-taking ability and risk-taking appetite to want to hold this thing in their portfolio. And then the top tier is just like, okay, you can buy this wherever you want. You can recommend this to your clients. So there's going to be some level of like these ETFs going from that bottom tier to the middle tier to the top tier. And every firm is going to be different with how long that takes, whether or not it will ever get to that top tier. So some of the big players, a lot of these like the UBSs, the Morgan Stanleys, LPL Financial, these people control trillions of dollars of wealth. So I'm hearing that some of them, I know for a fact, Stifel Nicholas, all these different platforms, they have different processes for what they can and cannot approve. Some have different timelines. Some of them are accelerating because a lot of advisors are very angry. I've talked to multiple advisors who are pretty upset with how slow this process is moving because they want to put in their client accounts basically back in January and they couldn't get it. So things might be getting accelerated here. So that means we know for a fact some of the biggest platforms with a lot of assets still can't buy these things. So it'll be interesting to see how much once some of those bigger platforms are able to buy them, whether or not it actually comes in. And I don't know if we'll see that in that first 13F report I talked about, that we'll see it comes 45 days after quarter end. So that's why I was saying mid-May. We might have to wait till the one after the Q2, after the June 30th time date, which would put us in mid-August. So we might not really know for another good time before how much advisors and some of these other platforms are actually allocating to these ETFs.
Yeah, I would just add, what you're saying is true, and I actually was a part of an investment committee at a large institution before this role, and I got to witness kind of how slow these processes can be. When you're onboarding or going through the gatekeepers to get new vehicles that you can allocate to in your models. But it's exciting. I think because of the spot Bitcoin ETF, professionals that are serving on these investment committees, across the country, now essentially have a shiny new lever to pull for the first time. I mean, we've always had, your U.S. large cap, small cap, European equities, and you go to the fixed income side, you got, investment grade, high yield, emerging market debt. And then, these are all kind of these traditional asset classes. But now, we're in 2024. And there's this new asset that has become available, which has different characteristics. It has a more asymmetrical return profile, and it tends to have a diversifying effect. If you look at it over longer periods of time, the correlation has been pretty low compared to the traditional asset classes. So all these things have kind of these interesting characteristics for portfolio managers to, sprinkle it in either strategically or tactically. But that's become available for the very first time. So I would agree with James. It's going to take time. And to that end, perhaps we might just be at the start of this. If you do get more institutions on board, you could envision a world where these flows continue to trickle in or even accelerate. So we just have to kind of wait and see. But certainly, if you had it on your bingo card that spot Bitcoin ETFs were going to be approved last year at this time, I think James and you and Eric were one of the first to stick your neck out on that side. So good job to that. But it's got to be exciting. But now we've got another thing that's in the pipeline, which is Ethereum. And these things have been filed. Certainly, we're working with some of the same partners for the Ether ETFs that we did with spot Bitcoin. And so, what's your take on that? What do you think's going to happen there? Do you think this is like a different animal, or are we seeing kind of like the same kind of analog path, as spot Bitcoin was?
Yeah. So it's not the same analog. That said, our odds right now are right around 60%. So cautiously optimistic. So my overall view is we can talk about the nitty-gritty details of the nuances and the minor differences of why the SEC might view Ethereum differently, or why they might try to deny here and kick the can down the road further. And there's a lot of reasons why they would do that, and we can get into those details perhaps if we want to. But the real overarching reason would be a political reason, which is why they were denying spot Bitcoin ETFs. And ultimately, the reason Gary Gensler approved those things, as he said in his following statement, basically they were forced to by the courts, right? That was the way that they looked at it. That was the way they pitched it. I think that was political expediency. Like, this was the best thing for investors. This was the best thing for pretty much everyone involved, just to approve these things. And his hand was kind of forced. Right now, his hand is not exactly forced in the same way. I do think the reason why I'm more positively optimistic, I'm over 50, not under 50 here, is one, it just makes sense. It's just a better situation for everyone involved. This, for retail investors, for the fund companies, this is an easy way to get exposure to Ethereum. We have the futures market in the same way that we have the Bitcoin market. We have the futures ETFs for Ethereum in the same way that we have the Bitcoin futures ETFs. So there's so many analogous comparisons between the Bitcoin and Ethereum for spot ETF approval. The problem is there's no court here telling the SEC what to do. If Gary Gensler wants to be completely political, he can. I just think he kind of turned the page on Bitcoin and Ethereum a bit. I think that the SEC has accepted Ethereum's commodity status via the way they handled futures and the approval of Ethereum futures ETFs. And I think just the path, they kind of like seem to have pivoted away from Bitcoin and Ethereum specifically, in my view, and are likely to wage war on the rest of crypto in a way, as we've seen with their lawsuit against Coinbase and Kraken, which we don't need to get into. But I think they're like, it's not worth the juice isn't worth the squeeze to fight this on Ethereum and Bitcoin. And I just think the simplest, easiest path forward is to approve these things, largely because if they deny, there's a good chance they end up back in the same DC Circuit Court of Appeals, the same federal court. And there are so many similarities. They got absolutely, if you read the decision from that DC Circuit Court against the SEC in victory for Grayscale, it was not just like a little victory. Like, they basically destroyed the SEC's reasoning and decision-making in denying those things. And if I'm Gary Gensler, do I really want to go back to the court and get that same sort of treatment, which is likely to happen? I don't think so. That said, if it's politically expedient for his political career to keep kicking this thing down the road and delaying, it's entirely possible. Yeah. And also the SEC, maybe they learned a thing or two from their go around with Grayscale and Bitcoin that they could lean on here for Ethereum. I just tend to lean at this point that they'll just approve them. But there's a lot of time left. May 23rd is the first deadline for the next one. So May 23rd is essentially the equivalent of January 10th, which is when all of these got approved. All the spot Bitcoin ETFs got approved. So we'll know more in the next month or two if we start seeing a whole bunch of updates to some of these documents in the way that we saw updates to the Bitcoin ETFs leading up to their approval. So there's a lot of information that still needs to be come out, I guess, before we can change our odds. But at some point in the next month or so, we'll have to either increase or decrease our odds from 60%.
That's brilliant.
That's
really,
stuff.
Really great. You covered a lot in that answer.
Yeah, sorry for rambling. I've had a lot of clients asking that question. So like I've had this conversation a bunch over the last week.
It's what we want to hear. Gabe, I think you had the follow-up.
Well, yeah, what I was going to jump back to is these updates. And I think in the Bitcoin side, we're would an example be when they had them revised to the create and redemption process? They wanted them to go from in kind to cash. When you see something like that, is that kind of like tipping the hand that, we are sensing that we might get the approval and we just need you to tweak this a little bit? Are these kind of examples that you would look for?
Yeah, so I'll give you the background on why we went to 90%. So to give you an example of what I might be looking for the Ethereum. So we went from 75 to 90% odds in early October, and that was right after everyone. If you're on crypto Twitter or Bitcoin Twitter, you saw a lot of basically the government was potentially going to shut down. The SEC was approving the Ethereum futures ETFs, and then went super early and delayed a whole bunch of these spot Bitcoin ETFs. And people were like, oh my God, they're just going to deny these things. But we saw that, and then we had the SEC de facto decide not to appeal the Grayscale case. So they still had time to appeal if they wanted to, but they didn't do that. But the real reason we went to 90% was because we heard chatter that the SEC had reached out to these issuers to talk about their prospectuses, to give comments back on these S1 documents. Now, we talked a little bit before, like the Winklevoss twins started this in 2013. We've had I don't even know how many spot Bitcoin ETF filings. It's over 50, maybe, different iterations of this. The SEC had never given comments on S1s. They was just always delay, deny on these 19B4 orders. To get one of these spot ETFs approved, you need two things. You need an approval on the 19B4, and you need approval on the S1s or prospectus or offering documents, depending on what you want to call them. They had never given comments on the S1s. Once we saw, I believe it was ARK and 21 shares were the first ones. Once we saw an S1A, which was like an updated document with a whole bunch of stuff changed about like minutia about how the fund would operate and risks that you would be exposing yourself to if you bought this fund, our view was like, that's the SEC giving comments on those S1s. They've never done this. This is a complete break of pattern. They're working towards approving. You wouldn't go out and go into the nitty-gritty details of these documents if you weren't planning to approve them by the January 10th deadline. So we haven't seen that yet for the Ethereum. The Ethereum ETFs, there have been some S1As, but they haven't been drastic changes or unique changes. For the most part, the ones we've seen are more bringing these Ethereum ETF applications in line with the things they learned going through the Bitcoin ETF. So they're changing things like the cash versus in-kind that we talked about. So that was obviously the SEC did not want in-kind creation. They changed the Ethereum applications to match that. They changed the Ethereum language about risk disclosures and things like that to match a lot of the risk disclosures in Bitcoin. So, and I've gathered and from talking to different people, this is basically the lawyers and these issuers just getting up to speed and bringing the Ethereum documents in line with the stuff they learned from Bitcoin, not anything specifically important to Ethereum itself. So if we start seeing a whole bunch of updates from all these issuers that are unique to Ethereum, that means the SEC is talking, and then my odds would go up. If we don't see that in the next month or so, we might have to decrease our odds. But I don't know how much time the SEC needs. The SEC needed like 3 + 4 months before, and they still had to cram at the last minute. I talked to a bunch of these lawyers that basically worked through multiple weekends, pulled all-nighters to meet the SEC's deadlines to get different documents to them. So they learned a lot from there, but I don't know how much time they're going to need to do the same thing with Ethereum, because there's obviously a lot of the same language that's going to be required.
So, just on that point, at the moment, we're still dealing with almost like a similar beast, or at least it's being treated like a similar beast. We're talking about Ethereum, but of course there is potential spanner we can throw into the works. And you know what that is, James? It's staking. I think a number of applicants have actually left the door open to potentially including staking returns in their applications. Now, we all know what the SEC's advertised view of Ethereum was, or maybe it still is. And if you sort of like introduce this element of staking, that sort of brings that a little bit back. How do you think that's going to play out with these sort of like lines included in some of the applications?
Yeah, I mean, if anyone knows about the SEC's view on staking, it's probably CF benchmarks and particularly Kraken. My view is, while I'm cautiously optimistic, and my base case is that these ETFs will be approved. Again, this is where, as I've stated, I'm nowhere near as confident as we were with the Bitcoin ETFs. I am fairly confident that these Ethereum ETFs will not be allowed to stake. My base case is that these things will be approved. 60% odds there. But I'm like 90% odds that if they are approved, they will not have staking. I just think the SEC is not going to allow it. They won't even allow in-kind create redeem. I can't imagine they're going to allow staking to happen. So down the line, I think it's possible. It'll be interesting to see what happens years down the line. I don't know how long that will take. I mean, we might get a new administration come the fall with the election. So I think you'll that could change things. But for the most part, my base case is, yeah, these things will be approved and they will not have staking. I just don't think it's going to happen. And you, like you said, two of them, I think a couple of the filings, they left in the possibility of seeing staking.
Yeah.
So if we see an S1 update like the one I was talking about, and those guys take out the staking, that's a good sign that the SEC is like, take that out. But there are other issues that already took it out and said they won't be staking. So there's two different ways to play this, but it'll be interesting to watch.
I'm just kind of curious, how would the SEC punt the football, further down the road? Because we do have a final deadline in May, right? But what are some of their options if they did want to extend? Does that impact your guys' probability of an eventual spot ETF if they were to, essentially figure out a way to punt it down?
When I say punt in this case, it's so right now there's going to be more delays from when this podcast comes out and with the May 23rd deadline. All those deadlines and delays and those punts, they're going to happen for sure. They're going to be delayed. They're going to be delayed and punted. They mean nothing. No matter what's going on, it's all going to be delays until May 23rd, in my view. I could look at the dates. Maybe we get something before that. But for the most part, it's all just going to be completely delayed. What I'm talking here is they would just deny. So if Van Eck is the first date on May 23rd and ARK for some reason is one day later, I don't know how that happened. Pure just paperwork, I guess. But May 23rd is the first deadline. If Van Eck is denied on May 23rd, I think everyone that has filed now, all 8 of them or 9 of them, whatever it is, they'll all be delayed or denied in that period. How could they do that? There's some arguments to be made that like the CME futures market isn't as correlated to spot Ethereum in the same way that CME Bitcoin futures are correlated to Bitcoin. I would say that argument is ridiculous. They are basically intertwined. And most of the arguments when the correlation was down was years ago. But the SEC used some of the reasoning for approving Bitcoin, leaning on how how correlated the markets are. But if you look at what happened since the spot ETFs were approved, the correlations between CME and spot got even tighter. They were already in like the 90 upper 90s percentiles. Now they're like near 100% correlated. So my argument against that would be what's going to happen if we approve the ETFs on the Ethereum side. It's going to be the same thing. So there's a bunch of different ways that the SEC could try to deny. They could try to deny for different reasons. They deny for Bitcoin. And again, I think they would any reason you come up with for the most part would probably end you up back in court, right? Like you'd end up back in court. So if you deny on the correlations or some other reasoning based on the underlying market, the futures market not being big enough, then all of a sudden it becomes irrelevant in a year or 9 months or by the end of the year. Like all of a sudden, then that reasoning for denial is going to be gone at some point in the near future. If things keep going the way they're going. So then all of a sudden your odds have to go up by the year end of 2024. So I'm 60% by May. If I have to go up 5-ish%, maybe more by December, depending on what they do to deny it. And then also if they try to deny on some more substantial reasonings or use the same stuff, they end up back in court, then you have a similar timeline. And then by the end of 2025, I can't imagine them by the end of 2025 or early 2026, my odds go up even higher because I can't imagine the SEC winning a lawsuit in the way that I couldn't imagine them beating Grayscale in their lawsuit. That said, who knows who would file such a lawsuit? Grayscale is not exactly thriving after being approved with their billions of dollars in outflows. They knew they would see significant outflows. So I don't know if they'd file the lawsuit and go against the SEC again for Ethereum. But yeah, it would be a denial, not a delay, not a punt in the sense, but it really would be punting because in my view, it's inevitable based on the fact that we have CME futures for Ethereum. We have the futures ETFs for Ethereum. I think ultimately it's going to happen in the next year or two. But in my view, I think the SEC would be wasting taxpayer dollars, tons of energy and effort if they try to fight this Ethereum ETF, in my view.
Yeah, I mean, it's actually, I can marvel at your probability because you're actually quite conservative. You've got a really compelling narrative, but you're still at 60%, 65% at best till into the end of the year. But
that could change in a month. In the month, I could go way up. The problem is, The reason
Yeah.
why we never went above 95%, even though I was basically I almost 100% certain it was going to happen, was Gary Gensler and Elizabeth Warren are such a
Yeah.
there's such a
Power
key
couple.
factor here, and there's so much political will and desire that's
Yeah.
impacting this. If you go on legal
Clearly.
and what should happen and how markets
Yeah.
operate and what like the most efficient answer would be, your odds should be 90% that these ETFs get approved. But this other factor here of the political side of things and the fact that the left wing of the Democratic Party, Gary Gensler and Elizabeth Warren are anti-crypto is something that cannot be overstated in my view.
Yeah, it's the political dimension is something to behold. Let's circle back to Grayscale. They've been pivotal, they've been controversial, and always interesting throughout the whole saga, and not least because they are obviously the largest fund that is not amongst the so-called CFB6, using our CME Bitcoin reference rate New York variant for net asset value. So they're also an outlier on that basis, and they're also not proposing at the moment to use our Ethereum counterpart, the CME Ether dollar reference rate New York variant for their Ether ETF. But I want to drill down on that really odd, for me anyway, bit of behavior on their part regarding their gambit to get into a potential Ethereum ETF. They've actually filed to list an Ethereum future ETF. What is going on there? We actually have futures already, and clearly they don't want to list a futures ETF on Ethereum. They want to list a spot Ether ETF. So what are they playing at?
Yeah, they are playing chess and not checkers with the SEC here. So if the SEC wants to try to do what I was just talking about, they are basically kind of trying to back them into a similar corner that they were backed into when they denied GBTC. So what we keep talking about the GBTC case, but it's still super relevant. One of the main things that decision I spoke about from the DC Circuit Court of Appeals, they focused on was actually an approval order from the SEC under the same 19B4 process. And that was for the Teucrium Bitcoin futures ETF. So they filed under that same 19B4 process. The other ETFs that came out in October of 2021 filed under the 1940 Act. We could get into that as much as you want, but essentially they didn't have to go through the 19B4 process. So the typical way you go through futures product and most of these all spot ETFs and many futures products is through the same sort of process, 19B4 process, where the SEC has to expressly approve these things before they list due to regulatory factors. So that order that they approved those Teucrium futures ETFs was a treasure trove for the Grayscale lawyers to argue why the SEC didn't make sense. So here's an example, right? They've been denying all these, they've been denying all the Bitcoin spot ETFs, saying that there needs to be a regulated market of significant size that the SEC can use to surveil to look for market manipulation and fraud. They've been saying, we need this, we need that, we need this. The problem is they approved the futures ETFs in the fall of 21, but they didn't have to go through the same process. So they didn't have to argue all this stuff. So then you come to May of 2022, where this Teucrium order is due, and they have to either deny these things, which would be insane to deny just because of a different regulatory process. That would violate like the way things are supposed to operate. Like there's virtually no difference between these things. You're denying them. So they didn't want to do that. So what they needed to do was find a way to approve this while also trying to thread the needle on saying why they're approving this and not approving spot, which in my view is just insane. These markets are intertwined. You're allowing a derivative of a market to list. I know those futures ETFs track at the CME, which uses CF benchmark, so I apologize. But your CF benchmark is based off of these spot markets. And so the way they threaded that needle was they said that the CME Bitcoin futures market was a regulated market of significant size with respect to itself. Basically, it's 100% of the market, so it's a significant market because the only market we're looking at is the CME Bitcoin futures market. Which there are so much other Bitcoin futures markets that aren't regulated by the CFTC on all these different crypto exchanges. So like just that was mind-boggling to me. But there was a whole bunch of other things they tried to finagle why they were allowing futures and then they wouldn't allow spot. So that document was basically critical in Grayscale winning that lawsuit. So now Grayscale's doing the same thing. Like you're going to write a 19B4 order. You're either going to deny this Ethereum futures ETF under 19B4, or you're going to approve it, and you're going to have to try to thread that needle again, and you're not going to be able to do it. So if you're not going to do that, we're going to give ammunition for us to take you back to court. Again, I don't know if Grayscale will take them to court. Maybe it'll be all these issuers getting together and splitting the cost, because Grayscale spent millions of dollars, and we're like, we have them to thank for having these spot ETFs. So we'll see. But they're basically they're trying to corner the SEC a bit here.
Well, I mean, I think you hit the nail on the head there when you were mentioning how, the way our reference rates work, we take order books from actual spot exchanges, right? So the futures are actually kind of directly linked to the constituent exchanges that we vet, and we bring that data through, and that gives you kind of the ultimate price in the end. After we adjust for trade weighted averages and prices like that, and different segment groups, partitions across the last trading hour, in this case from 3 p.m. to 4 p.m. for New York. But they've certainly put themselves in this corner before, approving futures products and then denying spot products. What would you say is kind of like the next ETF treatment if you're looking for other cryptos to become spot available? Are they going to need to have develop a regulated futures market similar to how Bitcoin and Ether already have?
Yeah, so that's the outline right now. That's what right now, as far as this administration is concerned, as far as history is concerned, you need a regulated futures market, and you need it to be like actually correlated to the spot market. You need to have years of history, and it needs to be like a significant market, right? But one of the things the SEC made a mistake on potentially is when the CME lists those futures, they have to register them with the CFTC and go through like the federal government. And when they listed Ethereum and the CME options and the micro futures for Bitcoin and Ethereum, they registered them as commodities futures, traditional futures. There's another option to register them as securities futures, which would then make those futures markets regulated by both the CFTC and the SEC. So if anybody tries to file, if the CME tries to file a futures market and doesn't register it as both as a securities future, and the SEC thinks it should, they can basically appeal that and be like, no, you can't list this because we think it should be regulated by both of us. They didn't do that with Ethereum. They didn't do it with any of the other subsequent things with Ethereum. They didn't do it with Bitcoin. And I don't think they're going to allow somebody else to list if they think it's a security. And we know a lot of the next other things. We know it based on the most common question I get about this question is Ripple and Solana. There's a couple others come up, but for the most part, those are the recurring themes. And I don't think, one, you won't be able to get a CME futures market because the SEC will say that they should be securities futures and basically won't let them list. CME and CFTC and SEC kind of are jostling right now. CFTC is saying that Ethereum is a commodity. SEC won't say either way. I think the SEC is going to be sufficiently ambiguous on that for as long as humanly possible. Like I said before, I don't think they're going to claim it to be a security. I also don't think they'll name it a commodity, because then you're giving ammunition to the Solanas and all these other coins of the world to say like, oh, we have all these same characteristics with Ethereum. So by being ambiguous, it's better for them in all these court cases that they're filing. So you literally, I don't think you can get the future. So I don't think that's happening. So you might literally need an act of Congress, a market structure bill, to get any other sort of spot ETF aside from Bitcoin or Ethereum. Absent that, I mean, like I talked about, you could see a change of administration. The SEC could stop being so hostile and regulating through enforcement and more regulate through rulemaking and talking with the industry if we get somebody else other than Gary Gensler and the Democrats running the SEC. But again, that also is going to take a long time. That's not like something that's going to happen like we get a new commissioner and then we have a Solana and Ripple ETFs out there. And all those things I said, a lot of like, I deal with the XRP army occasionally, and I roll my eyes, but like they're like, oh, it's not a security, and like that really doesn't even matter. Like it still doesn't satisfy their requirements for a regulated market. That's something they can surveil. Even if the Ripple goes all the way up the chain and gets an official like de facto, we are not a security, it still wouldn't allow us to have a spot Ripple ETF. So I think you have Bitcoin, Ethereum, and then basically,
right?
like I said earlier, it's everything else is a long way off, most likely.
Yeah, it's got to take some act of Congress, some sort of political regime change, essentially, to open up the other, cryptocurrencies. So, that's very interesting. Thank you for that.
Now, this is sort of like a question that arose out of what you guys were both saying, because it struck me, and it has actually struck me in the past kind of vaguely. Do you actually think the SEC was not aware that we derive our reference rates from the spot, and we provide that reference rate for the CME to settle the futures? They seem to not be able to, I mean, the gap in their argument seemed to say we don't know that this is actually based on spot. I mean, what do you think?
I mean, I was very vocal about this on my Twitter, like for years. Like this argument is asinine. Anyone who's worked in finance knows that like a derivative futures of an underlying spot market
I
is
know,
like
right?
completely intertwined. So one, I think
Yeah,
they know. Again, it's all political. Like as far as I'm
yeah,
concerned, this is one of my other theories, my tinfoil hat theory. Gary Gensler, the only reason we got those Bitcoin futures ETFs was because he gave a speech in August of 21 that basically outlined the path to get futures ETF through. He said, file under the 1940 Act. We
yeah.
look forward to those applications. And all of a sudden,
He
we had a
did.
bunch
I
of people
remember that
file.
actually.
ProShares
Yeah,
was first.
yeah,
And we get those
yeah,
things out. And honestly, that's the first domino that allowed that 2 filing to get approved
yeah,
and then allowed
yeah.
grayscale. So like you can literally thank Gensler's speech in August of 2021 for these approvals. So, and if you look at his time at the CFTC, he was almost like a digital asset cryptocurrency evangelist in the way that he handled the CFTC when he was running that. He taught cryptocurrency and blockchain at MIT. He knows this stuff. So my view is like he's doing all this for his political career, but deep down he's actually believes in some of this stuff and thinks it can add value. And that was a Trojan horse way to get these things approved. Again, tinfoil hat theory.
If I'm not mistaken, I think you did vote to approve. And what was it? Yeah, a 5-member committee.
It was the 2 Republicans that voted for. They've already had been dissenting. It was Hester Peirce and Mark Ueda, and then it's a 5-member commission. So it's like, so Gensler was the deciding vote. I think my view on that is they knew they were backed into a corner here by the courts. All the Democrats sat down and figured out like, how are we going to do this and save our political careers? And it was decided like, all right, the 2 Democratic commissioners that aren't the chairman are going to write a letter why this is the wrong decision, why they disagree, why they voted no. And then Gensler will vote yes and also write a letter saying like, I was forced to do this, but I also don't agree with it by the
Yeah, that
courts.
comes to my head.
Yeah. And it's, and I think, I don't know if they fully believe everything they were saying. I think it's just, they're politicians essentially. And this is,
yeah,
this
he's
is
a
the way they
political
handled
animal,
it.
clearly. Yeah, that's one thing I've definitely learned about him over the last 2 years. He's more of a political animal than I thought. So there you go.
It's sad,
think,
honestly,
yeah,
to be
yeah.
clear. It
No,
really
it
shouldn't
sad
be
in a
this way.
Yeah.
Yeah.
No, absolutely. You know, we sort of expect these people to be kind of bureaucrats, but you know, they're elected, frankly. So we have a slightly different system in the UK, James, guys. So it's slightly jarring for us. But okay, guys, we are at time. Gabe, did you have anything else?
Yeah, I mean, well, you had the weekend gap, which is, talking a little bit about when we say weekend gap, we have a underlying asset, Bitcoin, which trades 24/7. One of the, great selling points of having this kind of decentralized protocol and that it just kind of runs seamlessly on its own. Now that we've wrapped it into a spot Bitcoin ETF, these of course have trading hours. So, is there a problem really for investors that have to deal with the fact that when you're going into the ETF wrapper, you're not getting that 24/7, access to the market?
Yeah, I mean, in my view, it's not a problem at all. It's just the way this thing works. I mean, we have plenty of examples of ETFs that invest in markets that the opposite is happening. So the ETF is trading when the underlying market isn't. And I feel like that is potentially a bigger issue because you can't necessarily always source liquidity, but there are no issues because we have experienced market makers in TradFi who like do this for a living and make markets, put out bids and asks to operate this. But we also have the same thing, like you said, where it's the ETF obviously doesn't trade while the other one does. And it's no issue for the most part. As soon as the market's open, these things are going to price accordingly to where the underlying market is. And same thing at market close. The one thing I would say is for the most part, general rule of thumb, whenever you're trading ETFs, use a limit order. I mean, it's not like this is not recommendation like investment advice, but you should almost always be using limit orders. But really, you need to be using limit orders right at the open because wonky things can happen right at the open, right at the close, things around those times. So your 9:30 a.m.s and your 4 p.m.s on the East Coast. So for the most part, as long as you're being smart about that, it shouldn't matter. Yeah, you can't necessarily sell over the weekend if things start collapsing, and you can't buy over the weekend. Because it's only open from 9:30 a.m. to 4 p.m. East Coast time. So I guess, but that's just the way all of traditional finance works. It's like It's nothing to write home about as far as I'm concerned. It's like asking, like there's a reason that a lot of companies do their reporting earnings before and after market, because like they want people to digest it before the thing really starts trading again. So I don't think it's a big deal at all.
No, I mean, I 100% agree. And the fact is, crypto does have an added advantage despite the weekend gap when you sort of bring in the sort of TradFi world. You can actually hedge. You can hedge it over the weekend. You can hedge 24 hours, right? So, you've got to factor that into the potential downside impact if there is going to be some time. We'll round off, I think, with by paying homage to, the sort of asset manager that brought all this about. I say that slightly jokingly, but they obviously played a pivotal role. Grayscale, GBTC. Now, GBTC is infamously now still, in terms of fees, at 1.5%, 150 basis points relative to the rest of the street, where, even, major asset managers are, in double-digit basis points, 20.19, and even less if you factor in the sort of like a fee holiday that a lot of them have applied as well. Again, I'm going to have to ask you basically, what are Grayscale playing at? But I mean, that's pretty clear what they're playing at. They obviously made a pragmatic decision that some of their investors, the biggest, traded fund in existence, for Bitcoin, that is, will decide that the tax hit that they will actually be inflicted upon them when they do sell, if they do sort of exit, will be larger than what they would have suffered by continuing to pay the fees. Now, how sustainable is that? That's the question, because at some point, this is going to not be a good strategy for Grayscale to continue to pursue.
Yeah, so I have a lot of thoughts here. So the first answer is, it's very common in the ETF world to have an ETF that is the trading king, the liquidity king that market makers and traders go to, and they don't budge their fee at all. What a lot of these companies have done, namely iShares and State Street, you look at the gold ETFs, GLD charges 40 bips. They have GLDM, which is called the gold mini shares from them, that charges 10 bips, I think, or something like that. IAU and IAUM, the iShares gold ETFs. You have Spider has done the same thing with SPY, the S&P 500 ETF, and SPLG. You have, I mean, I can keep going. The emerging markets ETFs charges, EEM is the one that most everyone uses to trade, and that's one with the most options, liquidity, and things like that. So what ends up happening is, I think what Grayscale's plan was they could do that with GBTC. And my suggestion to them was, one, I thought they should have lowered the fee more than they have, but they've decided to stay there. I can explain what the logic was likely there. And they should launch one of those mini products that I was talking about. Keep GBTC at a high fee, allow people to trade it with a lot of liquidity, and then launch a sister product that is going to charge a much lower and will be used for people who are allocating for the long term and not necessarily trading, right? Those high fees don't matter if you're trading in and out. What matters more if you're trading in and out over shorter time periods, those bid-ask spreads. Is it trading at a premium or discount? And how much you have to pay to trade it, right? So the way that a fee works is it's like a little bit is taken out every single day. So if you're charging 1%, it's 1% divided by 365 that comes out every day is the way to think about it. That's not how it works in practice, but functionally that's how it ends up working. So if your spreads on the cheaper product, if the cheaper product only charges, rather than 1%, it charges 10 basis points, but the spreads on that are like 50 basis points, and you're going to trade in and out, all of a sudden you're going over the expense ratio GBT of the higher cost product, because its spreads could be 0.01% or 1 basis point. So I think Grayscale thought they could have kept that liquidity edge. IBIT seems to have taken it, but again, IBIT has relatively high spreads. It's kind of trading at a premium. So it's also not the best trading vehicle as far as many of those metrics would go. So it's yet to be seen how that's going to play out longer term. But right now, IBIT is definitely taking the volume crown. So I think, one, they thought they were going to be able to do that. Two, they knew they were going to see billions in outflows no matter what they did. They could have made the fee zero. They were going to see billions in outflows. You had FTX bankruptcy. You had other bankruptcy estates. They knew money was going to come out. So they probably figured, we said we would lower the fee, so we'll lower the fee. But we know a bunch of this is going to come out, so we're going to squeeze it for what we can. We know DCG has had issues with Genesis and all these other things. It's now widely reported, and I've been saying for years now, it wouldn't be surprised if Grayscale gets sold. So they're just trying to keep their revenue up. So the way to think about this, they were charging 2%. Let's say it was a $30 billion fund at the time, roughly. Let's say it was a $10 billion fund to keep the dollars around. They were charging 2%, so they're getting $200 million on a $10 billion fund, right? So like, you go from that
Yeah.
to then if they go to compete with the numbers you were talking about at 20 bips, you're
Yeah.
dividing that by 10. So you're going from 200 down to 20. And all of a sudden, like if you're making $200,000 a year, do you want to go to making $20,000? It's hard to make that cut. So the math is, all right, we'll go down 25% to 1.5% fee. And we just have to hope that the money that leaves isn't a 90% outflow of assets or the equivalent amount of outflow of assets that would cut the revenue. I mean, right now, as you mentioned, a lot of these things have 0% fees. Grayscale has earned more money this year as an ETF with GBTC than likely all of these other ETFs combined are going to make for the entire year and possibly even next year in revenue. So that was their calculus. And just to give you an example of like how some of this works historically, these assets tend to be sticky, right? You have some people's trapped by tax. They don't want to pay short-term capital gains or they don't want to pay gains at all. So they're thinking, I'll just take the fee. But some people are in IRAs and different tax-deferred accounts where that gains don't matter, so they'll sell out. A lot of people were in there, as we mentioned, they were just bankruptcy estates, so they were going to go out no matter what. A lot of people were buying GBTC and playing that ARB, as you mentioned, Ken, that were never going to be long-term holders, so we knew they were going to go out. But if you look at DXJ, which is the Wisdom Tree Japan Hedged Equity ETF, this thing is the only ETF aside from a BlackRock or State Street ETF that has ever had the flow crown for a year. It did it in 2013. And basically what it did, it bet on Japanese equities and hedged out the exposure to the yen. So the yen was super devaluing. It was like a rock star fund. So this thing went up to like almost $20 billion in assets, and then it drastically underperformed over the following years. But it took 5 years for those assets to go from $20 billion to collapse where they flatlined around $2 billion. And so like it takes a long time for flows to leave. Flows tend to be, I mean, we're talking it went from being relative obscurity, having like $50 to $100 million in assets, up to 20 billion, making a ton of money. And then money slowly came out as it underperformed. It's doing well now and money's coming in and its performance is doing well. But again, it flatlined at 2 billion. So like even at 2 billion, even at if that's a perfect example of something that no one cares about anymore, people just forget about these things. They don't want to deal with the tax gains. Like it just sits there. So Grayscale will be just fine. I think they should have lowered the fee a little bit more to be a bit more competitive. But it remains to be seen if they're going to do that or if they're going to launch another product or what have you. But that's probably the calculus that Grayscale went through. And then again, as I mentioned, you kind of throw in the fact that you have all these issues with DCG. They need money. They need revenue. They're dealing with the New York AG now. They're dealing with the Genesis bankruptcy. It's a mess over there. And they probably didn't really want to give up losing too much revenue here. But the flip side, sorry, I don't mean to keep rambling. DCG holds a lot of these assets. So like part of the benefit of becoming an ETF is that they don't have to hold these assets at like a 40% discount to the underlying value of the Bitcoin. So it also gave DCG liquidity. So some of these outflows almost certainly has to do with this Genesis bankruptcy and DCG's holdings. They're basically able to get the Bitcoin out at the value. Yes, there's no in kind, so it's taken in cash, but for the most part, it gave them liquidity. So there was a lot of benefit to them doing this. But they just kept the fee high because they thought they could. And it remains to be seen how well that's going to work out long term. But I think people are overestimating. Like people think this is going to go to zero in assets. And I mean, ETF history says that's not going to happen.
No, precisely. And you know what, James, that was the polar opposite of the boilerplate answer that you get, that we hear as well. I mean, I actually have never, I over-listen, I immerse myself in this stuff, podcasts, you guys are the same, I'm trying to convince you. But I've never heard that answer before. So that's exactly why we need to get you on here again, and that's exactly why we so appreciate you taking the time to join us this evening. We really, really appreciate it. Couldn't have wished for more.
Yeah, thanks for having me, guys. This was a lot of fun and glad I could nerd out with you.
Oh, man. It's a pleasure.
So, James, that was brilliant. We really appreciate you joining us because I think we got a lot of narratives there that you don't necessarily hear from many other platforms and many other sort of like outlets. We got the intelligent, informed analysis, which is exactly what we want. We need you to come back. So we really appreciate you joining us. And guys, if you want similar content to that, of course, you can go ahead and find other episodes of CFB Talks Digital Assets on all good platforms, Spotify, Google, Amazon, and Apple, of course. Beyond that, we do have a lot of printed content on cfbenchmarks.com. find the attribution reports, the quarterly attribution reports written by Gabe Selby, our monthly market reports by Gabe as well, and our newsletters, which are released more frequently as well at cfbenchmarks.com. Apart from that, we do appreciate you joining us for this episode, and we look forward to seeing you again for another episode of CFB Talks Digital Assets.